Hello and welcome to ULI-Philadelphia. This is Emerging Trends in Real Estate 2008. In Podcast 1, we'll hear from Stephen Blank, Senior Fellow Capital Markets, the Urban Land Institute. Now to introduce the program, here's Kenneth Balin, Chair of ULI-Philadelphia.
Good morning. As we get settled in our seats and get ready to begin this program, I'd like to just get us started. So if you haven't gotten your breakfast, keep getting your breakfast, and then let's get settled. My name is Ken Balin, and I am the chair of the Philadelphia District Council of the Urban Land Institute. The Urban Land Institute is an education and research institute with over 40,000 members around the world. Our mission is to provide leadership in the responsible use of land and in sustaining thriving communities worldwide. We're committed to bringing leaders together from across fields of real estate and land use practice to exchange best ideas and to serve community needs. We foster collaboration within and beyond ULI's membership through mentoring, dialogue, and problem solving. We explore issues of urbanization, conservation, regeneration, land use, capital formation, and sustainable development, advancing land use policies and design practices that respect the uniqueness of both built and natural environments. We share knowledge through education, applied research, publishing, and electronic media, and we sustain a global network of local practice and advisory efforts that address current and future challenges. Our members represent the entire spectrum of the land use and development disciplines. If you today are sitting here and you're wearing a badge that has a little green stripe and not a blue stripe, you're not a member yet of the Urban Land Institute. And those of you who say, and some of them do to me, that, well, my company is a member, I remind you as you listen to our mission that we're a member-run organization. Membership is very personal. It's about your own personal growth and development. It's about how we care about the world and the best practices and education that we bring together in a meeting like this and in the 50 programs that we do in this area and the thousands of programs that are done around the world are really put together by our members. And I invite you to be a part of it and help us grow this organization in Philadelphia and in our region and have an opportunity to be able to do and have more of an impact in our area. We have now over 1,100 members in our district council. If you are a member and you have a blue stripe and you're not actually engaged in one of our active committees, I encourage you to get actively engaged. There's a lot of really exciting work that is going on, and there's room for more energized people to network with one another and to help pursue our mission. Programs like this exciting program today are not done without the help of our sponsors. And our sponsors today, Citizens Bank, Chris Terlizzi, First American Title Insurance Company, David Feldman, and our supporting sponsor, Republic First Bank, Mark Kane, really are to be thanked by all of us. I'd like to take a moment and thank them now for helping us put on this terrific event. On your table is information about all of our sponsors, and if you're not a sponsor, if your company is not a sponsor, you personally, and you would like to help support our mission, please take a look at the information and feel free to contact anyone who is actively engaged that way. On your tables, you'll find also biographical information on all of our speakers and a list of upcoming Urban Land Institute events. And there's also information about from our bookstore, the Urban Land Institute bookstore, and there's information outside as well that you might be interested in. So this morning, as the panels go on, we won't have lengthy introductions of the speakers because the information is there. We'll be able to move forward. One last housekeeping item. Lunch today we're going to be joined by Mayor-elect Michael Nutter. There are vegetarian lunches available for those of you who want it, but there's a sign-up sheet for that outside, so if you need a vegetarian lunch, please get outside before 9 o'clock and fill that out. This program, and I'm glad you all found it today because I'm sure that some people went over to the Union League, is a new format for us. The last few years, this is the eighth Emerging Trends program that we've put together, and we've decided now, listening to the feedback on the surveys from most of you, that we needed to move to a slightly larger venue and we needed to expand the program. That the panels that the panel that we did and our response panel to our national speaker, needed to be separated a little bit with the different product types. Dealing with them a little bit more extensively. And so we've moved to this format. We'll be curious to see how you all react to it and whether or not it's something that we should continue to do. And we'll look forward to your feedback after the program. There are 2 microphones on the floor. After each panel, there will be an opportunity for questions. I ask you to please write them down and then move to the microphone and tell us who you are and ask your question. This is a educational organization. Don't be shy. If you have a question, I'm sure other people do as well, and I think that most of the real value comes out of these programs in listening and answering the questions that are there. The Urban Land Institute Emerging Trends in Real Estate program is really possible because of the joint venture program that is done each year in creating the book Emerging Trends in Real Estate, which is a joint venture between the Urban Land Institute and PricewaterhouseCoopers. So I'd like to now introduce Tom Wilkin, a partner in both the Philadelphia and New York offices of PricewaterhouseCoopers, who will start us off this morning with an introduction of our first speaker. Thank you.
Good morning. I'd like to thank all of you for coming today and welcome you to the unveiling of this year's findings of Emerging Trends in Real Estate 2008, a joint undertaking between PricewaterhouseCoopers and the Urban Land Institute. Now marking the 29th year of its publication, Emerging Trends in Real Estate is one of the most highly regarded and widely read annual publications in the real estate industry. It brings together the opinions and viewpoints of more than 600 active industry experts, including investors, developers, property companies, lenders, brokers, and consultants, who are interviewed or surveyed on an array of topics, including U.S. investment and development trends, real estate finance and capital market issues, property sectors, metropolitan areas, and other significant real estate issues. Emerging Trends in Real Estate provides a significant insight into what real estate experts themselves believe will occur in the real estate industry over the coming year. It is information that we believe is invaluable, and it is why we invited you here today, to get a first-hand view of this year's findings and facilitate some of the discussions about what its results and conclusions may mean to you and your business and activities over the next year and beyond. We are honored to have here today to present this year's findings someone who's had many years of experience in the real estate industry. Stephen R. Blank is a senior real estate fellow of finance with the Urban Land Institute, where his primary responsibilities include expanding ULI's real estate capital market information and education programs and authoring real estate capital markets commentary for ULI's website. He's participated as principal researcher and advisor to Emerging Trends in Real Estate series of publications and researching and authoring papers and articles on finance for issues in Urban Land magazine. Prior to joining ULI, Mr. Blank served as managing director of Real Estate Investment Bank of CIBC World Markets and its predecessor, Oppenheimer & Co. Mr. Blank is also on the board of directors of several public REITs and has participated as guest lecturer at the Harvard University Graduate School of Design and Advanced Management and Boston College of Graduate School of Business Administration. Stephen?
Thanks, Tom. I love these introductions. The only thing that Tom forgot to say is that I'm a recovering investment banker and I have not done a deal in almost 10 years. Okay, so I'm getting comfortable, so you get your seatbelts on and your lap harnesses good and tight, and let's try to talk about emerging trends. As some of you obviously have realized, this is being filmed, or I don't know exactly what you do to turn a presentation into a podcast, right? It's not film. I guess it is filmed. It's magic. Okay, so this gentleman in front is doing magic. So we warn everybody that, your comments, your questions, your oohs, your ahs, and your sighs, if he turns the camera, it's going to be on you. So now I got to figure out what we did in the first two slides that was contained in the introductions. We talked about the fact that this is a joint venture between the Urban Land Institute and PwC. It really talks about an outlook on the investment, the development, the finance, the capital markets, the property sectors and locations, and the issues that are really affecting all of us in the real estate business. Tom said this is the 29th year in the United States. It is our 5th year for our European edition and our 2nd year for our Asia Pacific edition. We added Canada this year. Our hope is to add Mexico and then Latin America, so that we will have a Americas edition in a couple of years. What makes emerging trends unique is the research process, which includes one-on-one interviews as well as in-print and online surveys with a wide array of real estate industry participants. And we talk to the institutional investors, the public and private owners and developers, the advisors and the service providers, the conventional and the securitized lenders. And as Tom said to you, there were over 600 people who participated in that process for the 2008 edition. So here are some quotes. We may be over-leveraged and have overpaid, but we're not oversupplied. Pro formers are too optimistic. Price-to-perfection deals could struggle under negative leverage. Fundamentals will need to carry the day, and nothing lasts forever. What's really interesting is these comments are not from the 2008 report. These are the comments from last year's report. So the industry, true to form, has used its predictive powers to tell us what was going to happen. But the fact is we sort of ignored our own best advice, and we kind of, pushed this bubble as far as we could until it actually burst. In 2007, we worried about exogenous shocks and bolts out of the blue. But as I said, we did little, to prevent one from happening. And then we got sort of blindsided by something that happened right next door to us in the single-family subprime mortgage sector. We try to just sort of define a little bit of the subprime mess. We had unregulated lending to consumers. We had a change in the business model of financial institutions. Banks used to keep about 80% of the mortgages they wrote and sold off 20, and now they've reversed that to basically selling off 80% of what they underwrite and only keeping about 20%. We had new categories of mortgage loans, like the Alt-A category and subprime, which started to occupy a greater and greater percentage of origination. The offloaded mortgages went to the investment banking firms, which then sliced, diced, and priced them and securitized them and sold them to investors worldwide. We had sort of a little bit of a fee-for-all with lots of conflicts of interest. And what we lacked really was, a due diligence mechanism at any stage of the process. The mortgage brokers who originated them, the mortgage bankers who accumulated them, the commercial banks that bought them, the securities firms, the rating agencies, and the eventual buyers of the securities. Nobody spent a lot of time doing much due diligence. The one benefit we can see from this subprime crisis is that it gave the commercial property sector the wake-up call that it really needed. And it gave it to us, in time before we did some damage to ourselves. So you'll see the dose of fear is in red, but it does not have blood dripping through it. So it's not going to be as dangerous as that. But clearly we are getting a dose of fear from what happened in the subprime market and its impact on the commercial finance areas. And I sort of call it's like a shake-up call. A shake-up call is midway between a heart attack and heartburn. Okay, and I think that's what we're sort of undergoing at this point. Who suffers, how much they suffer, it's just going to take a little while to sort itself out. I don't think we can really be predictive at this point. When we talk to people about their outlook for 2008, you know, we heard the terms like we're keeping our fingers crossed, the consensus is hopeful, we have to walk on eggshells, but the end game, you know, we are really certain is going to be a healthy, long overdue correction and greater stability for the commercial real estate business. Clearly what we're going to see is risk is going to be repriced, capitalization rates are going to increase. For the long-term investors, they've had a great 10 years, and they really don't bear a lot of risk from the adjustment that we're about to go through. But the traders, the speculators, the lenders, the bondholders all need to worry, especially about recent deals as they start to come near the horizon where they're going to have to be refinanced in the market. One investor said to us, this turmoil really could be good for the real estate industry. It will stop a lot of development. We'll see a flight to quality. We'll flush out the highly leveraged buyers, and trash will be repriced so buyers can get, you know, more upside returns. So we have this combination of a recession or a slowdown. Today I saw in the paper that one economist said we're poised for a slowdown. We have repricing. We have lower rental growth rates, all of which are going to, you know, impact and deal some sort of a blow to the retail, the hotel, and the office markets on a going forward basis. Survey participants believe there are really three keys that are going to determine how we're going to do in 2008. There's supply-demand fundamentals, capital flows, and the economy. And probably most of all, it's going to be the economy. But let's start by trying to take a look at everybody's view of industry fundamentals. As you can see, supply-demand really is in balance, especially in the top markets in the United States. But it's interesting to look at this chart. You know, what you don't see is you don't see that vacancy rates have gotten quite as low as they have historically at the top of a cycle, okay? With the exception of apartments, which are the pale sort of blue line at the very bottom. You know, nobody's really reached, you know, the cyclical low in vacancy rates that they normally have at the top of a market. Clearly, we know that growth in occupancy and rents has peaked, and spikes are certainly going to be a thing of the past. Well remembered, but something that won't be replicated for a while. If we look at development activity, we can see development is well under control except for condos and single-family homes in a number of markets. Development has been held in check by high construction costs and lengthy entitlement process, which has, you know, delayed or deterred some projects from getting done. We got plenty of retail under construction during a period of time where the investor, where the consumer is certainly getting exhausted. Hotels have continued to ramp up. I think people feel comfortable that hotels in the central business district are going to be able to withstand some pressure of recession, but people worried about, you know, the uncontrolled development in the suburban markets. Office is clearly in balance in almost all the markets nationwide. So fundamentals are okay, but you know, we've got negative leverage now. We have optimistic pro formas, and all of those are going to take their tolls as recent deals start to move through the pipeline. This weight of capital that we've all been enjoying, you know, has certainly compressed yields and driven up prices. But quick flips and, you know, someone to take me out, you know, really is going to be a thing of the past. We're going to now go back to the traditional race. You know, for values to stick, fundamentals need to hold up, and we need to have a shallow economic downturn. So we ask this question every year of people. We say, what's going to happen to underwriting standards? As you can see, the predominance of people think they'll be more stringent as risk is repriced. And I think actually this time they sort of mean it. You know, it's sort of the demure answer. No one would say that they really think underwriting standards are going to get any looser than they've been. Although I would like to meet the 8.4% of the people we've talked to who've been in a coma for the last 5 months. Because I want to borrow from them, okay? I don't want to borrow from the guy who's got covenants and escrows and, you know, and all those retro type of things like amortization. You know. One thing that is really good for the markets is we've got a natural backstop. You know, We've got the foreign investors who clearly see the advantages of buying in the United States for lots of reasons, including the weakness in the dollar. We have pension funds with huge accumulated amounts of money who are not highly leveraged and who have felt they've been sort of pushed aside by that class of buyers so they can come back to the markets. And we've got the real estate investment trusts sitting on piles of cash waiting to do transactions that are accretive. As someone described it to me, it's the revenge of the low leverage buyers. But, you know, consumers are stressed and housing is declining. Household debt is now 136% of disposable income. Wage growth has been relatively stagnant. New jobs have been coming in the service sector, and service sector jobs don't pay a lot, and they certainly don't generate a lot of demand for office jobs and office space. Financial services firms are seeing their volumes contract, are seeing staffs, you know, get cut. And I think, you know, from my experience, I would not be deluded if you see these sort of tepid articles in the newspaper, okay, because there's much more going on than is meeting the light of day. And when you see firms like Morgan Stanley, who yesterday talked about a $3 to $6 billion write-off, whereas, you know, 30 days ago they had about $1 billion worth of problems, you're seeing people really take a hard look at what's in that closet and start to make the hard decisions, you know, that they thought they could postpone, that they hoped that the market would improve and sort of take them out of. And I think people are now becoming pretty, you know, inured to the fact that the markets are not going to take them out, at least on any near-term basis, you know, before year end. This problem is going to extend certainly into the first quarter. What happens to the economy as arms continue to reset? And by the way, you know, there is no reliable number as to when they're going to reset. I've seen charts that show March of 2008 as the high water mark. I've seen charts that show November, okay? And we haven't gotten to the alt-A's starting to reset. So I think, unfortunately, there's just more pain and suffering there. But as defaults increase, as delinquencies increase, you know, how is that going to play through the economy? I think it's just going to be too early to tell. As I said, someone said this morning we're poised for a slowdown, and I think that's really sort of where we are. We've got short and long-term deficits. We have balance of payments problems. We have government and corporations and the individuals at the highest leverage they've ever had in history. And we have an economy that's not going to push rents or absorption or occupancy. So, you know, it's going to be a time to sort of, you know, sit back and watch a little bit and see how things play themselves out. Short sellers and long-term investors have done great, and if they have a year or two to follow of sort of ho-hum returns, you know, they're going to be just fine. Highly leveraged buyers and lenders and bondholders are certainly going to take some pain and suffering. Returns, people think if we go into a slowdown but not a recession, we're looking at mid to high single digits, sort of income plus a little appreciation. If we go into a recession, people are looking at mid to low single digits and probably some loss in value as incomes, you know, growth in NOI just does not keep up with, you know, increases in interest rates and cap rates. Any way you look at it, you know, we are finally moving back to what I would call the reversion to the mean, back to the long-term historical averages, back to the time, as my father would describe the real estate business, as a get-rich-slow scheme, you know, and I think that's sort of where we're going. But we're now going to go into the same race that we go into every time we come near a crisis. The economy and fundamentals and interest rates and their impact on cap rates. And that's what we're going to have to watch play out. We asked people sort of where you'd put your money. You know, if you're going to vote, were there other categories that you would do? And I guess as we all expect, you know, those of us in the real estate business, you know, continue to want to be supportive, you know, and believe this is the best place for us to put our capital. It's interesting, the only thing that outperformed United States real estate investments was real estate investments in Asia. And I think the reason behind that is pretty transparent. There's just greater alpha. There's greater velocity. You know, it's a huge amount of development. It's higher risk, and therefore it's much higher rate of return. But people do predict we're going to see lower overall rates of return than the supersized McDonald-type returns that we've been seeing in the past few years. Wall Street is clearly becoming the center of the game. As someone said to us, Wall Street has taught us a whole new vocabulary. There was alpha, then there was velocity, then momentum, and now we have contagion. Okay? But You know, the real estate industry is being Wall Streetized, as we would say. And location, 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 the old saw of the business, is starting to be replaced by a rap singer singing that famous real estate tune, Who's Your Daddy, Who's Your Daddy, Who's Your Daddy, financially. So, you know, Wall Street now controls the equity spigot. 40% of all mortgages go through the commercial mortgage-backed securitized mill. The commoditization has led to less influence by local sharpshooters, which clearly is a major change. And ownership has become sort of diffused and distributed, you know, through securitization, through the slicing and dicing of real estate into smaller and smaller parts. And now it's spread on a global basis. If you think the subprime mess is not a global problem, you know, and you haven't been following the hedge funds in Australia that have gone into bankruptcy, the banks in Germany who had to stop redemptions on their funds, you should know that the Bank of China opened up one of their closets and found almost $10 billion of subprime loans and collateralized debt obligations that had not been generally thought to be residing in mainland China. So you can be sure there's lots of other government funds that have large commitments to this area which have not just sort of fessed up to it one way or the other. We asked people to give us their buy, hold, and sell sentiment. And you can see that this year the buy sentiment is at 5.16, a slight increase from last year when it was 5. But what we're starting to see, though, is a trend towards an increase in the buy sentiment. If you look at the numbers over a couple of years, 2 years ago, we had the strongest sell history in the then 27-year history of the publication, okay? And that year combined with the weakest buy. So people basically said, I'm going to continue to play in the game, but I do not have much enthusiasm, you know? I don't have a lot of enthusiasm to buy, but I have capital, and I've got to get it employed into the business. So now we're seeing this change. And, you know, the markets, I think this tells you that the markets are going to become more realistic in terms of pricing. In terms of capitalization rates, you know, interviewees said obviously they see cap rates increasing, looking at about 25 basis points for industrial properties to 50 basis points for neighborhood shopping centers. As I've been giving this speech around the country, lots of people have come up to me and said, we're already at those levels. You know, we're moving past those. And I think people take sort of the conservative view. So if you wanted to take these up slightly, I don't think you'd find yourself being out of balance as the year goes by. And obviously, overall rates of return, internal rates of return will increase, you know, as cap rates. We ask people, what are you worried about? What keeps you up at night? You know, as you're traveling around the United States buying property, you know, what keeps you counting the dots in those, you know, those inlaid ceilings and all those great hotels you get to stay at? And people said to us the things that have concerned them were interest rates and the effect on cap rates, and job growth, which we clearly know drives the real estate economy, and construction cost increases. Now, interestingly, terrorism and immigration just didn't seem as important to people as they had in prior years, nor did the concept of outsourcing. Green, though, is here to stay. And while clearly this has been the year where the green movement, where being environmentally conscious, has been democratized in the United States and has been adopted by, you know, everybody from school kids to grandparents, it's also been adopted by the real estate industry. And people feel that this issue will get continuing traction. It's here to stay. We'll start to see increased pressure from our tenants and from their employees, you know, for buildings that are green, that are environmentally sensitive. We clearly know what the Green Building Council is doing for, you know, new construction buildings. We're starting to see a nascent responsible property investing movement where people are talking about how do they implement continuous improvement to the 92% of the real estate environment, which is as built already. So I think we're going to see more and more of this, and this will be something that will occupy more and more of our time and our planning as we go forward as an industry. This slide is done in memory of mortgage brokers in Orange County, California. You know, for 2008, clearly in the financial services area, layoffs and lower bonuses and lifestyle changes are going to be the rule of thumb. And asset and property management are going to become increasingly important. Workout skills may even come back in vogue, and we'll talk a little bit about that in a minute. You know, the question that everyone is trying to, you know, everyone's been asking for years, but now we're going to see happen is what happens when owners of commercial properties meet special servicers in commercial mortgage-backed securities. Is this going to be a peaceful process, or are we going to be knee-deep in litigation? And I sense it's going to take a little time. It's going to be difficult for people to work this out. If we look at delinquencies, the high water mark, for those of you who remember, was June of 1992, when commercial mortgage, 7.5% of all commercial mortgages were in default or delinquent. So clearly, if you can see today, if this was a patient, it would have to be on a respirator. Okay, you'd say, it's probably flatlined. We can turn it off. I mean, we have never seen delinquencies as low as they are. In the CMBS area, they're about 25 basis points, 0.25% of the total outstanding mortgages. In the conventional balance sheet lender area, they're down to about 8 basis points. Okay. Now, I admit that the balance sheet lenders have been very strategic in how they handle their loans. As soon as they have a loan that has a problem, they sell it. They get it off their books, get it to somebody else, let them work it out, and not, start to take these things into inventory. I don't consider that artificially working the numbers. I think that's running a very, very strategic business model on a going forward basis. So for 2008, obviously we're seeing slower and lower growth. For the hotel business, it's kind of the cyclical application of what always happens. Hotels start to build. They build into tremendous demands in the central business district markets. As cities are doing better and better and the economy does well. They build into the franchises build in the suburbs, where land is available, and basically it's easy to get financing for that. And we're now headed towards that cyclical slowdown that we see. As the economy slows, companies will dial back the amount of travel for their employees. Consumers will start to dial back on their vacations and the amount of discretionary travel. And we're going to start to see the hotel business go through the other end of the cycle, the weakening part of its occupancy and absorption area. We look at office, we look at the other things. We're now looking at more secular trends. Offices continue to be influenced by technology and outsourcing and hoteling, all of which are squeezing the amount of space needs that companies have. Companies, we have more and more people who are telecommuting, in some way working at home, working at remote locations. Hey, you can't get into a Starbucks in most cities, but, and get a little computer line because there's so many people who are using the Wi-Fi there. It's like the office of choice. In the retail area, we still see continuing inroads from the online retailers. I think the perfect example is Land's End made an announcement that said that their online business had exceeded their catalog business. Now, I would have found that to be absolutely impossible because I would have said that Land's End, like LL Beans, were the ultimates of catalogs, okay? But just take a look and see that you're getting less LL Bean catalogs that you used to get, and that's because the online sales business is really starting to gain a huge amount of traction, and people are now willing to buy clothes, okay, as opposed to things, and I think that's a change. As someone called us and said to us, this was the revenge of the nerds for sure. You look at the logistics business, people are trying to figure out, how do I get links out of that chain, out of that distribution chain? How do I take one property away from it? I mean, someone said to me, listen, we own these throughput facilities at the airports. The planes come in, the stuff is unloaded. It goes through customs right there. It goes out the other side. It goes into a truck or onto a train and goes directly to the consumer. He said if we could figure out how to get the consumer out there, we would take out the truck bays. So they're going to try to just keep compressing that and take out a link anytime they find one that they think is sort of a little weak in the process. So let's talk about the markets. Now, this is called the beauty contest part of the experience, okay? Let me remind everybody, since we're close to Atlantic City, what happens in a beauty contest. There are four stages. There is the swimsuit issue, right? There is the ball gown. There is the talent, and that's followed by the inane interview, right? Okay, but in emerging trends, we only have the swimsuit issue, okay? So basically, remember, the rankings that we're going to talk about, whether they are high or low, are rankings of the perceptions of people about markets. It doesn't say they have any knowledge of the markets. It doesn't say they even know where the market is, okay? But when given a list, this is how they seem to be voting, all right? So if you don't like your number, whether it's high or low, what you need to know as you meet visitors from out of town, as you deal with investors or lenders from out of town, okay, they're going to come in to see you with a little bit of a bias, all right, in some way relative to other markets. And our ability to sell through that, to mitigate that, to get our presentations to reflect what's really good and positive, is what makes the difference, on a going forward basis. So with that said, okay, New York is sort of doing, super well and is just sort of a little bit ahead of everybody at the moment. Class A office space has vacancy rates of less than 5%. We have leases routinely going at $125 to $150 for office space. Okay, they're talking retail rents in the $2,000 a square foot in certain locations. Numbers that are just hard to absorb. And someone said to me, I don't want to compete with those. Okay, I don't want to get up there because you got a long way to fall if you get down. But clearly, prices and values have continued to increase in New York to stratospheric numbers. It does remain a world financial center. It is a 24-hour city, but it's clearly near a peak. No one thinks we're going to see a sharp correction, more like a flattening, sort of like the market going, enough already. I need a break. I'll be back in 12 months. Don't go anywhere. And so I think, we're just going to see New York peak out for a while. While New York is clearly on top, the rest of it looks like it did last year. It's kind of put a smiley face, on the map. And that's where investors want to be. They want to be in the coastal markets, the global pathways. They're just concerned about the interior, suburban areas and suburban cities. And so they want to stay in that sort of smiley face, near the water. On the West Coast, Seattle is doing great. It's just a little bit behind New York in terms of the total numbers. It's on the Pacific Rim. It's got its own trade routes. It's a 24-hour city. It's got a diversifying business mix. It's got Microsoft. It's got Boeing. It's got WAMU. It's got Costco. It's got Amazon. And it's got Starbucks. So it's got intellect and it's got jet fuel to keep it going 24 hours a day. San Francisco's another 24-hour city, coming back well because the tech is coming back in the San Jose markets, and that's infecting San Francisco. West Los Angeles is starting to do really well. Even the downtown area is starting to improve as we start to see some condos opening and people moving into the downtown market again. The local industrial market in the Los Angeles basin is just, the tops in the United States. It's the strongest market. Ships just wait offshore, to get into that market. We'll talk about how that's changing a little bit of the distribution patterns. Orange County certainly is losing some steam, as the mortgage brokers downsize. If you want to follow, by the way, not that you might, but if you do want to follow what's going on in the mortgage broker banker mode, you can go and visit on the internet the Mortgage Implodometer, okay? It's a website, ml-implode.com, and there is a listing of all of the mortgage bankers and brokers who are no longer with us. And last time I looked, it was about 170, and that's since December of 2006. So it's I don't know whether it's interesting or frightening, but if you just have nothing to do, go to the Mortgage Implodometer. San Diego sort of got a little bit ahead of itself and now is suffering from housing and condo prices, starting to get dragged down by excess supply. It was the #1 market 2 years ago. It's got a lot of great fundamentals. It's always going to be up near the top, but I think it just got a little bit ahead of itself. If we look at the East Coast, people see Boston as a 24-hour city, even though it's lost some of its financial services and banking headquarters, as well as Gillette. They see Washington, backstopped by the government. Even though it's sort of getting to a plateau and the suburbs are getting a little bit overbuilt, people say, the federal government will sort of backstop that market, just on a going forward sort of basis. Miami and the other Florida markets, are suffering from condomania and just a host of issues, including insurance costs and water supply. I mean, there are 45,000 units, it said, in Palm Beach, Dade, and Broward County that are available for sale at this point. And it has become a new business for lawyers in that market to examine purchase contracts to try and find flaws to get people out. There are also more than one case of people walking away from deposits in the six-figure numbers, under the theory that they don't want to throw good money after bad. So there's certainly a lot of things that are, questions in people's minds, especially as it relates to the Miami area. But Miami still remains the gateway to Latin America, and it's the financial services capital of the entire Caribbean basin. We start to look at the Sunbelt markets. Denver is clearly leading that market here. It's got light rail. Its lower downtown area is really becoming a 24-hour core for the city. It needs more residential, but I think they're making a lot of progress towards that. Phoenix is starting to cool off. The housing supply and prices certainly just got a little bit ahead of themselves. Atlanta and Dallas have the same sort of problems they always do. They're sort of the boom, the bust, types of economies. Development always is ahead of demand. The zoning will, allows a tremendous amount of development, and so that makes it difficult for these cities to get into a stabilized area. Both cities clearly benefit from world-class airports. The Buckhead Midtown area of Atlanta and the uptown Dallas area are trying to emerge as sort of their 24-hour nodes within their suburban sprawls, and maybe they'll make some real progress this year. But people still worry about, these suburban agglomerations. You've got increasing congestion, you've got insufficient infrastructure, and it's hard to maintain growth on a long-term basis with those issues in front of you. The Midwest, just remains challenging in people's minds. They certainly like Chicago. They're thinking about Minneapolis. But they worry about, where's the economic growth coming from? Where's the job growth coming from? And if I invest in these markets, what's my exit strategy? Who's going to sort of take me out on a going forward basis? So let's take a look now at the property sector rankings. Industrial and apartments really remain everybody's favorites. The supply-demand is under control. Both are good, steady income producers. Demographic trends clearly favor the apartment business. We have echo boomers becoming young adults. We've got housing in meltdown. We have more and more people wanting to move back into the cities to get rid of their large houses. So as those trends progress, it keeps the apartment business in good shape. The best industrial markets are the ones that are clearly around the global ports, whether that's LA and Long Beach or San Francisco or northern New Jersey or Miami. All of them are doing great. What you are starting to see is the development of what we call inland distribution centers. And whether that's Harrisburg or Columbus or Kansas City, areas that are convenient to intermodal traffic, that are taking some of the pressure off, the coastal distribution centers that just cannot move the merchandise fast enough. The office markets in the CBDs are holding up. The suburbs clearly are going to suffer a little bit because development, is relatively easy to start and sort of remains a little bit out of control. Businesses continue to sort of try to get themselves into these global pathway cities because that's where they meet their trading partners. Hotels we talked about 2 years ago. That was number one in the rankings, but we clearly think we're at that point where the cyclical factors of a slowing economy and less discretionary spending are going to have their impact on that area. Everybody worries about retail and consumer exhaustion. Clearly, the fortress malls are going to do great, but you're going to start to see the B and C malls get stressed if their tenants start to decide that we need to move to a fortress mall to be near our consumers, okay? Or if we start to cut back on stores. So there is the potential for some weakness in that area. Infill neighborhood centers are going to do great. The ones you have to watch about are these new projects out at the fringe, near those housing communities. They're having difficult times marketing housing at this point. Housing, no one's got an accurate prediction of how long this is going to take to sort itself out. Certainly, we're looking at 2008, and we're probably looking at, in some markets, this problem extending into 2009. But there have to be some best bets. There have to be some places that we should try to put our money going forward. So here's a series of what we think from the people we talk to, are the best ideas, the best investment best. Build relationships, get your capital house in order, look for good real estate with bad capital structures, okay? Do not wait around for trouble to happen, because when that does happen, you're going to be competing against a huge number of people, including, all of the large players, who built systems during the last crises, okay? So we think that the real way to make money is to find good real estate with upside-down financial structures, grab the owner by the hand and say, let's go see the bank or the financial institution and try to work this out now before we move into crisis mode, okay? Much better chance of getting a deal put together economically, we think. If you can get your hands around some distressed loans, whether it's B pieces or mezzanine debt, if they're available, and you can find things that are secured by good collateral, clearly that's going to be a great opportunity. But again, it's going to be highly competitive. All the investment banks have got huge amounts of capital to put into the area. The global funds have huge amounts of capital, so it'll be highly competitive. Obviously, it's a great time to hold core properties. We always see a flight to quality when the markets start to become unsettled, and those properties are clearly going to maintain value. Focus on the 24-hour markets. There's greater buyer demand. There's greater upside potential. There'll be greater liquidity going forward. So, clearly these are the markets that we should focus on. Concentrate on operations. Now is the time to make sure that you are the guy who can out-manage, out-lease, out-renovate, out-reposition, out-retenant, who can do all those basic skills that make the real estate business work, because this is going to be a time that the guy with dirty fingernails is really going to make, I think, the most amount of profit. Look at the public REITs, look at the home builders, the brokerage companies, the mortgage company stocks. At a point in time, they're going to become buys. The REITs have gone down substantially in the past month. There's been a real revaluation. They were probably selling at 10 to 15% premiums. Now they probably, as a group, are selling at 10 to 15% discounts. There was a transaction named this week where Gramercy Capital bought American Financial Realty. Huge amount of discussion going on about pricing and how the pricing would have been substantially higher probably 6 months ago. Okay, so here's the first evidence of a real break in pricing. All right, so I think it's an opportunity to watch these companies, and when you think you're near some form of cyclical bottom, start to make an accumulation. A lot of people are talking about demographic strategies, whether that's student housing, medical office, senior housing, baby boomer resorts, second homes, whatever it might be that takes advantage of the changing demographic trends. My generation, the baby boomers, is getting closer to retirement. We're changing our asset profile from growth to income. We're starting to look at ways. The kids are gone. They are out of the house. They are out of college. They are on their own. It's our time to try to enjoy the fruits of some of those labors. And for those of you who may think that this market is going to get a lot worse than it is, now's the time to start staffing up and toning up the workout teams. Get the people in place and make sure that you really have the business plan and the model to start to execute. In terms of development, obviously we say think green. It'd be hard-pressed to advise anybody to do any new development that doesn't have a big green component and tries to find a way to comply with one of the lead standards, one way or the other. Focus on mixed use and infill. People increasingly want to live in the 24-hour cities. They like the residential environments. They like the choices of housing, whether that's condos or single families or apartments or townhouses. They like being close to service retail, the grocery stores, the pharmacies, the cleaners, and the restaurants. And we're starting to see this, increasing number of people moving back in, giving up those homes, and the empty nesters and the career starters wanting to be in the cities because that's where the action is. Obviously, building anything near transit-oriented development, as we've said for any number of years, almost can't miss in any market in the United States. If we try to look at the property sectors, our best bets would be to look at acquiring B and C multifamily properties and upgrading them in markets that got relatively high housing costs, okay? Between in-migration, and the echo boomers, we have a huge market that's built into that area. Certainly, it's a great time to buy and hold industrial properties. Our economy depends on a tremendous amount of imports, and these properties are real cash flow machines. We say to people, focus on the East and West Coast gateway markets because that's where really all the action is. Now's a good time to, if you can buy and hold residential building lots, all right? Single-family builders, to the extent they still have any on their inventory, need some way to get that stuff off their books. There's more and more of it that's starting to go on the market. So if you have the experience and you have the courage, now's the time to try and make a deal while these guys are suffering sort of the most that they're going to suffer. Be careful in office and hotels. Hotels are going to, be hurt by this cyclical downturn in the economy. The office area is clearly under some secular pressure from outsourcing and technology and hoteling and all these concepts that get people to work at home and not in their offices. And as we said, there is a little bit of a chill on retail because people really are worried about the consumer and exhaustion. Fortress malls and the infill grocery anchored centers are going to do great. It's the B and C malls that we got to worry about. It's too many lifestyle centers outside of the main markets waiting for development to catch up to them, and that's going to be delayed for a while. As I said to you, we covered Canada this year, and it's interesting to see that when you look at the Canadian markets versus the United States markets, they're just a little bit more under control than we are, but they've got strong housing and strong fundamentals, and I'll let you go through and read those at your leisure. So, thank you all very much for coming. It is really a pleasure to play Philadelphia, as they say. I am, mesmerized that we could turn out 600 people in 2 tiers. This is almost like sort of a rock concert for emerging trends. So I do appreciate it. I'm happy to answer any questions that you have. I know we have a few minutes for questions, and I think you've got a great program, and I think it's going to be a terrific day. So thank you all very much.
We hope you enjoyed this Urban Land Institute podcast recording. If you have comments or suggestions about these podcasts, please email steve@professionalpodcasts.com. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. For the Urban Land Institute, this is Steve Lubetkin. Thanks for being with us, and take good care.